Afternoon, everyone. Thank you again for taking time from your busy schedules to participate in our third quarter webcast. Nick Botticelli, our Chief Strategist, and Matt Underwood, our Director of Portfolio Management and Research. We're going through kind of the 3Q history, what happened in the markets, and then we'll talk about our outlook. We obviously are also in the process of completing the formal third quarter reviews and we're scheduling individual meetings with all of you. So this is kind of our agenda for the day. I'm going to turn it over to Nick now, and then I'm going to come back at the end and talk about a lunch event that I know many of you have already registered for that we're going to have here in Phoenix at the end of this month. So Nick.
Great. So yeah, good morning, good afternoon to everyone. I'm going to start here talking about our third quarter 2021, our active strategic tilts and our action items. So first, looking at fixed income, we maintain a shorter duration tilt in fixed income. This makes us less performance sensitive to interest rate moves, especially moves to the upside that are being talked about today in the markets. We've also reduced high yield bond exposure as the expected returns for the asset class are significantly less attractive than it was during spring of 2020. We've replaced that exposure with a combination of floating rate exposure via a security called SRLN and also private credit, mainly variant. In the equities, we maintain a modest overweight to value style and small cap in the US allocation, but at the higher level, we maintain a modest overweight to non-US markets where valuations are more attractive. In private markets, as you all know, we've increased our private market allocation significantly over the last year as we favor private markets relative to public markets. We will be discussing moving to overweight positions in private markets in client accounts depending on the tax consequences during the third quarter reviews. We will also be discussing with clients a proposed allocation to two new private market investments. The first in private equity is Hamilton Lane has a private asset fund. This will complement the AMG Pantheon exposure in the portfolios. And the second is a private real asset exposure to Starwood Real Estate, which is a good complement to Blackstone BREIT. The final update for kind of the quarter comes to technology. So as we mentioned in the past, we've partnered with a new portfolio management client portal software provider. We're currently in the process of onboarding the software, loading in all the history, reconciling the data, and we plan on rolling out the client portal access later in the fourth quarter and at the beginning of the first quarter of 2022. When looking at the markets, kind of from a high level, investors have, they haven't been afraid of risk. There's been a lot of, investing in equities and the high flyers in the markets, but that softened here in September. Equity snapped a 7-month winning streak in September, which drove third quarter returns negative. This was mainly driven by concerns over inflation and the associated supply chain bottlenecks that I'm sure everyone's hearing of. The Federal Reserve, for the first time, acknowledged that inflation pressures may be more persistent than originally expected. They also discussed the potential for an interest rate hike in 2022. This drove interest rates higher. The 10-year just during September rose from about 1.3 to 1.5. The Federal Reserve also stated that they may start a reduction in the bond purchases. They said that it may soon be warranted. So nothing really concrete on the timeline, but not to be surprised if they start slowing down those bond purchases going forward. And then in DC, there's been some political gridlock in Congress and the House around the infrastructure bill and raising the debt ceiling, which, they're working through, but nothing's been decided as of yet. Looking at the job market, recently released job numbers show the jobless rate continues to decline in a positive manner. And private markets were a bright spot for us during the quarter as all the semi-liquid private market investments posted positive returns where fixed income returns were mixed. Looking at the actual numbers, during the quarter, global equities, as I mentioned, they took a pause from the year plus rally that we've all experienced, and we're down just over 1% for the quarter. The main drivers to the underperformance or the negative performance were small caps and emerging markets. Core fixed income was slightly positive and high yield had a good quarter, up almost 1%. Looking at the year-to-date numbers, global equities are up over 11%, a very strong return, especially coming off of the strong returns in 2020. This was mainly driven by US equity returns, which have kind of led the way. Commodities and public real estate are having, continue to have good bounce back years after what was a tough 2020. And within core fixed income, there's been mixed returns here, as I mentioned. Both muni bonds and kind of corporate investment grade credit hovering near zero returns for the year, as high yield has returned 4.5%. Looking at some of the key metrics, the US Treasury 10-year yield has been volatile, but ended the quarter up slightly and has now risen by 0.6% for the year. The Fed's fund rate remains at 0.25%. Chairman Powell has discussed the possibility of raising these rates in about 12 to 18 months. Unemployment, as I mentioned, continues to slowly improve. It's improved by almost 2% so far this year. And inflation has arrived. The latest core CPI reading is now at 4.3%, up almost 2.5% for the year. I mentioned earlier that the semi-liquid private markets were a bright spot in the portfolio over the quarter. And what we have here are those returns broken out by private credit, private equity, and private real assets. So I'll be discussing mostly that second column there, the three-quarter valuations. So in private credit, both Variant and Blackstone BCRED returned, plus or minus 3% for the quarter. This outpaced core fixed income by about 2.5 percentage points. In private equity, Pantheon produced a 5.5% return relative to a 4.6% return for global equities. And a real shining star in private real assets, Blackstone BREIT, which has had a tremendous year, had a great last 3 months of valuations, up 7.4%. This has produced about a 7% outperformance relative to a mix of global equities and core bonds. The rose and blue, little darker blue, Hamilton Lane, PAF, and Starwood S-REIT. These are kind of newer names to our lineup. These are portfolios, investments that have been approved here recently. And as I mentioned earlier, we're going to be discussing these in the fourth quarter here when we do our Q3 reviews and be providing recommendations for those allocations.
So the last quarter was volatile, with equity starting off the quarter, the first 2 months in an expansion after earnings expectations were exceeded consistently by reporting companies. So this is a continuation of the positive economic and market trends over the last year. However, September lives up to its historical nature as the month with the worst average performance over the last 20 years. September was marked with drops in sentiment driven by anti-business crackdowns by the Chinese government, combined with systemic risks questioning the Evergrande, which is a Chinese real estate company with large systematic exposures in the region. In addition, the FOMC, or the Fed, showed the potential for a tapering of bond purchases and the potential liftoff from the zero bounded rates in the next year or two. So the quarter wound up ending after being up almost 4.5%, having almost a 5% drawdown, ending down 1.1%. Now, breaking out the equity performance by the underlying global regional constituents, we see that the reflation trade favorites like small cap and emerging markets lost on a relative basis. They gained some of the losses from the start of the quarter by the end, but still suffered a significant September drawdown alongside US large cap equities, which actually stayed afloat through the course of the quarter, winding up basically flat to the beginning of July. Now, jumping over, US Treasury yields remain sturdy for over the quarter. We have a longer term look here just to see where these rates sit in context. But from early July to September, the 10-year Treasury has been in a relatively tight range of 1.2 to 1.4. But in September, rates rose after confidence increased when the Fed voiced their tapering plans. So currently, the two-year to 10-year spread is relatively low versus historical levels. But with the Fed on the verge of reducing asset purchases, we initially expect the slope of the yield curve to slightly steepen. However, once policy rates come into view, the curve should flatten as short-term rates increase in lockstep with the Fed. Although we should still keep in context that the level of rates now is still meaningfully lower than we saw through September 2018. So this is, not necessarily, a cause for warning at this level. We still have some buffer available, but we're definitely watching the impacts of inflation on the 10-year Treasury yield rate.
Kind of looking forward now, look at our current capital market assumptions. The expected return landscape has not changed that much since last quarter, and that's partly due to kind of the muted returns that equities and fixed income have had over the quarter. Core fixed income returns on the left here in green continue to be historically low levels. Core fixed income looking at, just shy of 2%, where high yield and floating rate are closer to 4%. In the middle, in the blue bars, U.S. equities. In equities, U.S. large cap valuations are extended, resulting in lower forward expecting returns of about 5%. Better opportunities, we believe, exist for higher returns in non-U.S. markets. And global equities, when you put it all together, expected to return just shy of 6%. Private markets continue to have the most attractive expected returns. When we look at our major asset classes, those expected returns are anywhere from 8 to 11% annually. These asset classes provide a sizable return premium to public markets, and we will aim to increase client allocations to private markets during the fourth quarter. Looking at our U.S. equity risk premium signal, as I mentioned in the past, this is our most important investment decision signal in our proprietary model. This analyzes the expected return difference between U.S. large cap equities and the 10-year Treasury bond. The jagged dark blue line shows the relationship back in time, and you see it's fluctuated to being very attractive for bonds right at the tech bubble, and then being very attractive for stocks at the end, about 2008, 2009, when we had the global financial crisis sell-off. On the page prior, I mentioned how U.S. large cap returns are on the low end, but as you can see in this chart, the current signal, which compares U.S. large cap to the U.S. Treasury returns, lands between 1 and -1 standard deviations, so in the middle of the distribution. This informs us to hold a policy weight to both bonds and equities, as U.S. large cap equities are fairly valued relative to the 10-year Treasury, since the 10-year Treasury's yield is also on the low end of its historical values. Looking now specifically at equities, we look at the equity valuations both from an absolute standpoint and a relative standpoint. The chart on the left shows U.S. large cap equity valuations are on the high end of the range, making them less attractive than non-U.S. indices. That reading of 38, as you can see, is second highest it's been prior to the tech bubble. And that's caused because the U.S. market valuations, we compare the price movements to the earnings of the underlying companies. And since the global financial crisis, you'll see that U.S. equity markets have kind of just shot up there. That's due to the fact that the prices of the companies have outpaced their earnings growth. And typically you want to see a better relationship, a more even relationship between the stock price gains and the earnings. The non-U.S. equity valuations here on this chart are currently near long-term averages, again, providing higher expected returns going forward. The chart on the right compares the valuations of U.S. large cap equities to emerging market stocks. Emerging markets, as you see at the beginning of the chart of that jagged blue line, were significantly more expensive in the 2000s. Emerging markets had outpaced U.S. markets. But post the global financial crisis, U.S. equity valuations have soared, while EM valuations have remained below their historic average. This has resulted in a significant discount for investors to own future emerging market earnings relative to the U.S. large cap. That's one of the signals we look at that help us derive our tilts to emerging markets in our model. Looking at interest rates and inflation, which have been occupying headlines in the news. What I'm going to discuss here is a concept called real yields. Real yields are the result of subtracting out the inflation rate from, in this case, the 10-year Treasury bond yield. So on this chart, the 10-year Treasury bond yield is the blue line. The real yield is the shaded gray area. This calculation informs investors what they should expect to earn on an investment after you factor in inflation. When inflation was sub 2%, this wasn't a really big topic because investors were still earning positive returns even after you factored in inflation. Today, we have low 10-year Treasury yields with higher than average inflation, resulting in real rates that are negative. What does this mean? It means that for $1 invested today in a 10-year Treasury will have less purchasing power in the future than it has today due to the inflation relationship. This relationship is yet another data point that directs us to reallocate funds from core fixed income into higher yielding asset classes like private credit and private real assets. The story's similar when we look at credit sensitive fixed income as well. So on this chart, we look at high yield bonds and investment grade corporate bonds. High yield, which we added to client accounts in the spring of 2020, offered outsized returns at that time relative to fixed income. Since then, we've realized those outside returns and we've started to reduce those allocations and in some cases, eliminate them from client portfolios. As The reason being, today the return premium over Treasury bonds is lower than pre-COVID. And there's a similar signal when you compare what core fixed income is relative to its history. Again, this relationship points us to reallocating from fixed income to other asset classes like private credit and private real assets. Right? When we think about private credit and private real assets, these semi-liquid investments, they provide us with higher expected returns, higher yields, and in most cases, especially in the real estate, a very strong inflation protection hedge.
For the last 10 years, inflation's been range bound and has been unlikely to stay significantly above the Fed's 2% target for an extended period of time. So this changed with COVID, and we see the spike on year-over-year inflation from the lows of the pandemic on the right-hand side of the chart. As those lower values roll off the trailing one-year calculation, the impact of these lower base effects is reduced. So since they're staying elevated, it's showing that many of the components of inflation are not as transitory as the Federal Reserve may want us to think. In fact, Fed Chairman Powell did not choose to use the word transitory in his last statement to the public. So we're looking at inflation, potentially staying around for a little bit longer, and that's going to have an impact on steepness of yield curve as bond market investors demand compensation for tying up their capital over longer periods of time due to inflation. When we take a look at the underlying, price and causal relationships of that rise in inflation, we see that one of the main contributors is energy. So energy up almost 48.1% over the last several years, but we see a pretty stark spike since the lows of COVID, where it's almost 100% up since that point. So really, some of these effects are, tend to be very volatile and cyclical. Energy being one of them. However, one of the things we want to make sure that we look at are things like housing and wage pressures. Those tend to be very persistent, and they're being elevated relative to history. Signals that the cyclicality and transitory nature of inflation may not be as quick to revert as originally thought. Take it to the next slide, please. Now, looking at the unemployment data, this is another key component that is considered to drive inflation. So we see that at the beginning of 2020, we saw that we were at about 3.5%. During the COVID drawdown, unemployment peaked at 14.7%. And then rapidly, as those jobs were filled, we saw that unemployment rate come down fairly rapidly through October, and then a little bit more gradually since then. Now, the last read for unemployment is at 4.8%. Now, the constituency of those people in that 4.8% is different than it was pre-crisis. However, the interesting thing is that even though we're not at a level that would be considered full employment, we are already starting to see pressures from a wage inflation perspective. That's started to enter the system. So the Bureau of Labor Statistics actually stated that wages are running at about 6% year over year annualized over the last 6 months. So that level hasn't been breached, in the last probably 25 years. So it's definitely something that we're paying attention to when we're talking about the persistence of inflation in the system. Now, another thing that we like to look at as one of our indicators for risk assets is the amount of dry powder on the sidelines. So this is the showing of money market levels for institutional and retail funds. This is measured in trillions of dollars. So what we see is historically, this has been fairly range bound, about $3 trillion across the entire economy. But we saw in COVID that spiked up to almost $5 trillion, actually a little bit over $5 trillion. Some of that money has come off the sidelines and been reallocated, but there's still a significant amount of liquidity left that could potentially be a tailwind should the future become more known and consistent. So that way, investors and companies can actually allocate their capital more effectively in a more structured environment where they can actually size and price their risks. And finally, looking at the leading economic indicators, this is a data read from the OECD, which is an economic indicator that represents factors across 37 countries. and it basically gives an indication of where trends in GDP growth drivers are going. So the baseline for this in the long-term average is 100. And so numbers above 100 are considered to be expansionary. Numbers below 100 are expected to be contractionary. So we see that the most recent read for this, which is about a month stale, is at 101. So it's actually showing that some of the key drivers could lead to growth greater than, more so than contraction. Whether that growth is, flat to 1 or 2+ percentage points, that's to be determined. But it's significantly better than it was at the depths of COVID, where basically all the indicators were signaling significant contraction, which we then subsequently saw in the economy. So on a forward-looking basis, this indicator would say that we wouldn't necessarily want to take too much risk off the table, in alignment with what Nick said before with our equity risk premium model.
So I'm going to finish up. I appreciate everybody taking time once again from their day to do this webcast. Once again, we're scheduling the 3Q reviews. We'll be in touch with all of you about that. I want to remind all of you that we have a lunch event that we are sponsoring here in Phoenix at the end of this month. Our guest speaker is going to be Joe Zidle. He's the chief investment strategist from Blackstone. Many of you probably are familiar with Joe. He's a frequent commentator on all the major business networks. You'll see him on Bloomberg or CNBC TV. He's a very exciting speaker, and we're really thrilled that he's here going to be in town. So if you've not yet registered, we've sent out an email. You can send an email to me or Nick or any of our team members and say, I'd like to attend. We are going to cap the attendance, and our intent is to hold it outdoors and maintain as much distancing as possible. And if it turns out to be a little bit warmer day than we expect, the adjacent ballroom has collapsing doors that can be open and allow fresh air. So we're hoping as many of you as possible can attend. It's an exciting event, and we look forward to hopefully seeing you there. Otherwise, thanks again for your time today. We appreciate the trust and confidence in our organization, and we look forward to speaking with each of you soon. Thanks so much for today.